Welcome back to Curious Commerce. The topic working capital management, continuation from part 10. Two businesses are in the same profit, same city, same customers. But one business runs smoothly while the others always struggle with cash. Why? What is the reason? Because working capital is not only about money, it is about many hidden factors that decide how much cash a business actually needs. Now we will clearly understand factors affecting working capital. Majorly, five most important ones are nature of business, size of business, production cycle, credit policy, and market condition. Once you understand these, you will start understanding business cash problem like a professional. What does factors affecting working capital mean? Every business needs working capital, right? But the amount required is different for business to business. Because of this, business needs depends on type of the business, how big the business is, how fast production happens, how customers pay, and market situation. These influences are called factors affecting working capital. Let us understand each with simple example. First one is nature of business. The type of the business directly decides working capital needs. For example, in case of service businesses or service sector, the working capital level is very low. For example, in the case of service businesses, the consulting firms, coaching centers, freelancers, digital marketing, software services, they don't need big stock, right? The raw material is not necessary and warehouse also. So working capital requirement is low. But in the case of the trading business, the working capital is medium in nature. The working capital is essential. For example, retail shops, wholesalers, distributors, they must maintain stock, variety of goods, and storage, or the inventory, or the warehouse. So they need moderate working capital. But in the case of the manufacturing business, the high level working capital maintenance is essential, or the working capital importance is very high in the case of the manufacturing businesses. In the case of the factories or the production units, they need the huge working capital. Or in the case of the batch production, or in the case of the mass production, or in the case of the line production industries, they need the huge working capital. They need money for buy raw materials, for work in progress activity, for store the finished products, or for the salary or wages to the laborers or the employees, and power, the electricity power, and transportation facilities. So manufacturing businesses need the highest working capital. On the basis of our discussion, it is possible to conclude that nature of business decides whether working capital need is low, medium, or high. The second factor is size of the business. Big businesses need big working capital. Small businesses need small working capital. It is very simple. For example, a small kirana shop, stock worth around 50,000 rupees, and few customers and very low expenses, needs small working capital. It is a common sense, right? But in the case of big supermarkets, stock worth around 50 lakh, hundreds of thousands of customers daily, many staff, high electricity, and high rent, needs huge working capital in the case of the big supermarkets. As the business grows, more customers, more stock, more staff, more expenses. So working capital requirement automatically increase. Bigger the business, bigger the working capital. Smaller the business, smaller the working capital. The third factor is the production cycle. Production cycle means time taken to convert raw material into finished product and sell it. Short production cycle demands less working capital. Long production cycle demands more working capital. For example, bakery buy flour today, makes bread today, sell today, cash comes quickly. Working capital requirement is low. But in the case of the furniture factory, buy the wood now, store the wood for certain duration, and cutting, designing, polishing, finishing, deliver after certain days or certain weeks. Money is blocked for a long time. So working capital requirement is high. In the case of the real estate projects, construction takes years. Money is blocked for a long period. So working capital requirement becomes very high. Longer the production cycle, higher the working capital needed. Shorter the production cycle, lower the working capital needed. The fourth factor is the credit policy. Credit policy means how much credit you give to customers, how much credit you get from suppliers. Once again, I will repeat how much credit you give to customers, how much credit you get from suppliers. This directly affects working capital. If business gives more credit to customers, sales increase, but cash comes late. More money gets blocked in receivables. So working capital requirement increases. For example, if you sell goods today and customers pays after 60 days, you need money to run business for 60 days, right? If businesses get more credit from suppliers, you buy goods today, pay later, less immediate cash needed. So working capital requirement reduces. And the base of our discussions, generous customer credit, more working capital needed. Good suppliers credit, less working capital needed. Smart businesses manage both sides carefully. And last factor is market condition. External market environment also affect working capital. During the boom, high demand, sales increase, stock needs increase, more working capital required. But during the recession, low demand time, sales decrease, stock remains unsold, cash gets blocked, working capital stress increases. In case of the inflation, raw material prices rise, stock cost increases, more money needed for same quantity. During the uncertainty, like war or pandemic or crisis, payment get delayed, customers hesitate, cash inflow slows. So market conditions can suddenly increase working capital needs or create working capital crisis. That is why smart business always keep cash buffer. So remember these five powerful factors affecting working capital: nature of business, size of business, production cycle, credit policy, and market condition. Working capital is not random. It is designed by business reality. The entrepreneurs who understands these factors can predict cash needs, avoid cash crisis, and grow business confidently. For more such practical businesses and finance knowledge, explain simply and a curious commerce. Thank you all. For daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. The topic working capital management will be continued in part 12. Share, subscribe, and like. Thank you all.